Markets move because money moves, and money moves for a reason. Follow the money. The United States owes more money than any country in human history. Every second, that number changes. Every day, new debt is issued. And every year, the total becomes larger. For many people, this sounds impossible. Who would lend that much money to one country? Would you? Would I? The answer is yes. Not directly, but through banks, through pension funds, through investment funds, through central banks, and through millions of investors who may not even realize they are lending money to the United States. Debt always has two sides. Someone borrows, someone lends. Without a lender, there can be no debt. Which raises an important question. Who are the lenders behind the largest loan ever created? To answer that question, we first need to understand what America's debt actually is. When the US government spends more money than it collects in taxes, it has to borrow, not from one person, not from one bank, but from the market. The US Treasury issues securities, Treasury bills, Treasury notes, Treasury bonds. Investors buy them. The government receives cash, and in return, it promises to repay that money with interest. It sounds simple because it is. Every Treasury security is nothing more than a promise. A promise that the United States will pay you back. That promise has become one of the most important assets in the global financial system. Banks own it. Insurance companies own it. Retirement funds own it. Governments own it. Central banks own it. Money market funds own it. Even ordinary investors may own Treasury securities without ever buying one directly, because many mutual funds and retirement accounts already hold them. This is why America's debt is far more than a government balance sheet. It is also one of the world's largest investments. And that changes how we should think about debt. Most people imagine debt as a burden, something to reduce, something to avoid. But financial markets see something different. Every Treasury bond is also an asset. Someone's savings, someone's retirement, someone's reserve, someone's investment. The same dollar that appears as debt on one balance sheet appears as an asset on another. That is the first idea. We need to understand America's debt exists because millions of investors believe those promises still have value. And before asking whether America's debt is too large, there is an even more important question. Who is making that bet? For many years, one image dominated the conversation about America's debt: China. Many people believed that China was the largest owner of US government debt. And while China has been an important holder of Treasury securities, the reality is more complicated. The largest holders of America's debt are actually inside the United States. The first group is institutional investors, pension funds, insurance companies, mutual funds, banks. These organizations manage trillions of dollars for individuals, businesses, and governments. They need assets that are considered stable, liquid, and reliable. U.S. Treasury securities fit that role. A pension fund, for example, needs investments that can preserve capital over decades. A bank needs assets that can be traded easily during uncertain times. Treasury securities became one of the foundations of modern finance. The second major holder is the Federal Reserve. During periods of financial stress, the Federal Reserve has purchased large amounts of Treasury securities. These purchases are designed to influence financial conditions and support market stability. The third category is foreign investors. Countries around the world hold U.S. debt as part of their reserves. Japan, China, the United Kingdom, Canada. Many countries hold Treasury securities because the dollar plays a central role in global trade. But foreign ownership is only one part of the story. The bigger picture is that America's debt is deeply connected to the entire financial system. It is owned by institutions that manage people's savings, by organizations that protect financial stability, and by investors who believe U.S. Treasury securities remain one of the safest assets available. So the real question is not simply who owns America's debt. The deeper question is why so many different investors choose to own it. Owning America's debt is only half of the story. The more important question is why. Why would investors lend money to a government that already owes trillions of dollars? The answer is not based on debt alone. It is based on trust. For decades, the United States has built the deepest and most liquid government bond market in the world. Every trading day, trillions of dollars move through the Treasury market. Large investors can buy or sell billions of dollars within minutes. Few markets offer that level of liquidity. For banks, that matters. For pension funds, that matters. For insurance companies, that matters. And for central banks, it matters even more. Around the world, countries trade with one another every single day. Oil, natural gas, food, electronics, raw materials. A large share of those transactions are settled in US dollars. That means central banks need dollar reserves. And those reserves cannot simply sit in cash. They must be invested somewhere. For many countries, U.S. Treasury securities became the natural choice. Not because they wanted to finance America, but because they needed a place to store large amounts of dollar assets. Japan buys treasuries to manage reserves. China buys treasuries to manage reserves. Many other countries do exactly the same. In this system, Treasury securities are more than debt. They become the financial foundation behind global trade. Every shipment crossing an ocean, every payment between companies, every reserve account held by a central bank. Somewhere behind those transactions, Treasury securities help provide stability. This is why America's debt cannot be understood as a national story alone. It is also a story about the global economy. And once money begins moving through that system, it follows a path far larger than any single country. Now, let's follow the money. Imagine a treasury bond being sold by the United States government. An investor buys that bond. The investor sends cash. The government receives the money. But that money does not remain inside a vault. It begins moving. The government pays for roads, military equipment, social programs, healthcare, scientific research, interest payments. Contractors hire workers. Employees receive wages. Businesses receive payments. Consumers spend money. Banks receive deposits. Companies earn revenue. Investors receive income. The dollars continue moving through the economy. Some of those dollars leave the United States. American companies buy products from overseas. Consumers purchase imported electronics. Factories import raw materials. Those dollars arrive in other countries. Exporters exchange them through commercial banks. Central banks accumulate dollar reserves. And once again, they face the same question. Where should those dollars be invested? For many institutions, the answer returns to the same place. U.S. Treasury securities. The dollars that once financed government spending find their way back into the Treasury market. The cycle begins again. Borrow, spend, trade, save, reinvest. This is not a straight line. It is a continuous flow of global capital. Every treasury bond connects governments, banks, companies, workers, and consumers across continents. America's debt is not simply money that was borrowed. It is part of a financial network that links nearly every major economy in the world. And that network continues operating for one reason. The capital keeps moving, but every financial system has an important question. What happens if demand changes? What happens if investors become less willing to buy U.S. Treasury securities? This question is often misunderstood because a change in demand does not mean the system immediately fails. Financial markets adjust. Prices change. Interest rates change. Investors reconsider where capital should go. If demand for Treasury securities becomes weaker, the first adjustment usually happens through price. When fewer buyers want a bond, the bond price can decline. And when bond prices decline, yields rise. Higher yields make new debt more expensive. This is the mechanism that markets use to find balance. But the United States also has several sources of demand. Domestic investors continue to play a major role. Pension funds, insurance companies, banks, investment funds. The Federal Reserve also influences financial conditions through monetary policy. And global investors continue to use Treasury securities as a major reserve asset. This does not mean there are no risks. Higher interest costs can create pressure on government finances. Large amounts of debt require careful management. But the important point is understanding how the system responds. Markets rarely move from stability directly to collapse. They usually move through a series of adjustments. Higher costs, changing incentives, new buyers, different strategies. The real question is not whether America can borrow forever. The real question is whether global investors continue believing that U.S. Treasury securities remain the most important financial asset in the world. After following the path of America's debt, one thing becomes clear. This is not only a story about borrowing. It is a story about trust. A Treasury bond is ultimately a promise. A promise that the United States will continue to honor its obligations. For generations, that promise has become one of the foundations of global finance. But financial systems do not exist because of numbers alone. They exist because millions of people and institutions make decisions based on confidence. Confidence that markets will remain open. Confidence that assets can be traded. Confidence that agreements will be respected. This is why America's debt matters far beyond the United States. A pension fund in one country, a bank in another, and a central bank thousands of miles away can all hold the same asset. A U.S. Treasury security connects different economies through one financial network. That network has supported global trade, international investment, and the movement of capital for decades. Of course, the system faces challenges. Debt levels matter. Interest costs matter. Fiscal decisions matter. But understanding the system requires looking deeper than one number. The important question is not only how much debt exists. The important question is why so many investors continue to hold it. Because in global markets, money does not disappear. It moves. It moves from investors to governments, from governments to economies, from economies back into markets. And behind every movement, there's always a decision. Someone believes one asset is worth holding over another. That is the real story behind America's debt. Not just who owes the money, but who continues to trust the system.